Hi, Taylor. Nice to meet you.
Hi, Samantha. Pleasure to meet you. Hi, I'm Jessica. Nice to meet you. Thank you so much. Samantha. Pleasure to meet you.
Hi, Taylor. Nice to meet you.
Samantha. Thank you so much. Thanks so much. I'm Jessica. Nice to meet you.
Good afternoon. I'm Chris Gordon. I'm the facilitator for the afternoon. I wanted to welcome you, and I wanted to thank our judges for their time that they're giving us for the day. I'll do a quick introduction of our judges. Mark Whitley from EMCO, Kelly House, Scotiabank, Jane Button, Scotiabank, Greg Sauter from Saskatchewan Rough Riders, Ron Stiles from SaskTel, Mohammed Torjisi from the U of S. Competitors, you have a maximum of 20 minutes for your presentation today. Immediately following the presentation, the judges will have a total of 5 minutes to ask the presenters questions. During both of these times, I will be giving you time cards so that you know where you're at during your presentation. At 5 minutes, I will give you a 1-minute warning, and I will knock at 30 seconds so that the judges know that their time will be up in 30 seconds. I will keep time throughout the whole presentation. Audience, there is no questions, comments, cell phone, or picture taking will be permitted at any time. Please ensure that your cell phones are on silent or vibrate. Audience, please clap only at the end of the question and answer period. And we ask that you exit immediately after so that the judges have time to fill out their scorecards. You'll get started right away. 1 minute. Confirming that your team J? Yes.
Yes.
When you're ready. Okay.
Good afternoon, potential Borealis investors. We're so excited to be working with you because we know that you see the value in modernizing what is typically seen as an antiquated business. When you think of auctions, you're often thinking of a traditional brick-and-mortar auction house where people are raising their paddles to bid silently. But we're thrilled today to be presenting you with an opportunity to acquire this company, as well as to develop it into an international platform that will be enabled through brilliant online technology. We fully feel that although your current capabilities are not in the online world, one thing that will differentiate you from all other competitors is that you really have a fantastic competitive advantage in the sense that your customers trust you. You're known for superior quality through both your appraisals and your auction houses. And lastly, you provide a full service capability that currently nobody else in the market is able to compete with. So let's take a look at some of the issues that we're looking at today. Firstly, the primary issue at hand is whether or not to acquire Borealis and to look at a potential prioritized growth strategy. You've identified for us a lot of different potential strategies, but we're really going to take a step back and focus on what you should be looking at in the years to come. And of course, we want to be able to make sure you're able to meet your growth goals so that you have the option to sell in 5 to 7 years. The main issues we've identified in this business for you today is that you're facing tough competition. As I've mentioned, your domestic and international competition have begun to outshine you in some senses, and we want to make sure that you're able to compete with them in the future. Secondly, your management capabilities. Although you have amazing operational experience, there are certain requirements that we're going to need to look forward to, able to take this strategy and grow it beyond your current Canadian market. And lastly, declining revenues. One thing that we've noticed here is that in the past few years, although you have had tremendous success overall, you're facing declining revenues in the last couple of years. Our recommendation for you today is that we're going to be looking at pursuing a focused growth strategy, particularly aiming for the United States East Coast, and of course for you to acquire this company moving forward. And the impact for this recommendation today is a 17% return on investment if you do choose to sell within a 5 to 7 year period.
We are just as excited as you are by this opportunity. However, we understand that in order to make sure this opportunity reaches its maximum potential, you have to address certain issues. So let's take a deep dive into what those issues are. As my teammate alluded to, one of the key issues you're facing is competitive forces, and that comes from competitors, small business players, as well as that big major market leader, Ritchie Brothers. But alternatively, there are substitutes on the market as well. So as the Canadian economic downturn progresses, a lot of key customers are looking for cheaper ways to do things, such as going through online platforms that enable private sales. Now, why does this matter? Well, it matters because it affects the total share of the market that you are able to obtain at home. And secondly, it should shape how you react to your competitors and how your competitors will react to you. Secondly, your management team has amazing capabilities in some things such as daily operational management. You have experience in sales, and you have worked with large equipment and plant manufacturing in the past. However, we think that in this private equity deal going forward, you need to develop some new capabilities, and you need to develop them in order to ensure that you're able to meet what your customers demand. And so in the traditional auction business, a lot of it is relationship-based. Right now, you don't currently possess those relationships with your key customers. And as you know, of the 70,000 customers on the in Borealis' customer base, 1,000 of them are very high volume, high worth customers to you. And with some of management leaving, there might be a relationship-based gap to fill. Next, so as my team alluded to, in recent years, from 2013 to 2014, Borealis has seen a 26% decline in revenue. And then from 2014 to 2015, that revenue decline continued. Now, you've told us that part of this is attributed to vacation time. However, we also think that it might also be in part due to the fact that there are fewer buyers in the Canadian market due to the declining economy, as well as those threats from substitutes taking away your market share. Now, why does this matter? Well, it matters because the first step to realizing the full potential from this acquisition opportunity is to secure that loan from the bank. You need to convey to the bank that you can mitigate these issues, manage them, and ultimately build the foundations to turn what might be issues right now into strengths going forward. And we're so happy here today to be able to present you with a plan to do that. So, in order to assess alternatives going forward, we have to keep the following decision criteria in mind. The first one, you have to protect your current value proposition of quality, of trust, of a full service, of flexible offerings to your customers to retain those high volume customers in the future. Now, that means that your future plan of attack cannot alienate your current customers while safeguarding against those competitors and substitutes that I mentioned before. Secondly, you want to meet that 30% revenue growth. This is an ambitious goal, and we understand that. However, we think that you will be able to meet this if you expand geographically. Now, thirdly, It has to be feasible with the financing constraints. As you know, the previous owners took a lot of the retained earnings and paid them out in dividends. So therefore, your cash balance right now is low. So we must make sure that whatever we propose to you today can be done with just the financing from banks and from some private investment from your friends and family. And lastly, you need to reduce your dependence on the relationships with your current customers, because those are usually serviced by the existing management. And we don't want to be too reliant on management that might not be as invested as you into the long-term future of the company and might leave the company in a few years.
So this all sounds very daunting to achieve, but even though this is a great time for you personally to be looking at this, it's also a great market to be looking at right now. One of the best advantages to this is that as a Canadian looking to potentially expand into the US, there has been no better time than at present. What this enables you to do is to provide competitive prices that are guaranteed by that brand of quality that you already provide to customers. And so today, in looking for a strategy going forward, we're going to really leverage this and be able to compete with the current competitors that are in this field. So going forward, we've looked at 3 potential options for you. The first was to grow aggressively through an acquisition strategy, mainly through the 30 or some odd competitors that currently exist in Canada. So we would focus on the acquisition of smaller companies and focusing on your traditional line of auctioning, potentially less so focused on the appraisals. Secondly, we looked at a US-based growth strategy, as we've been mentioning to you throughout this presentation, which would be enabled through a new online platform. And we would also be incorporating these appraisal services and offering them to people so that once you do make a purchase or sell something through the online site, that it would automatically come backed by an appraisal through the company and be able to pair that quality of both the product and the service you're able to offer to customers. And lastly, we did look at a focused domestic growth strategy. However, as we've mentioned before, there isn't enough evidence to prove that this would be able to help you actually achieve your growth goals going forward. So now looking at these 3 alternatives that I've outlined for you today, and in coupling them with the criteria that we've laid out, we can see that while acquisitions may help you reach your revenue growth, and it may or may not be potentially aligned with your current value proposition, it's not necessarily feasible with financial constraints. We are not absolutely certain you'll be able to acquire and that you have the cash on hand to be able to do so. So we've knocked that option out. Similarly, for domestic growth, although it is status quo with what you're doing right now, it's not necessarily going to guarantee the revenue growth that you're looking for. That's going to be necessary if you're looking to sell this in 5 to 7 years. So ultimately, we feel that entering the US is the best way to go about this in juggling these 4 criteria. So what is this specifically going to look like? So this US-based growth strategy is going to continue to serve your current market base, which is highly based out of Ontario, but it's also going to develop new relationships with a new customer base, primarily in the East Coast, where you already have most of your American customer base. So we're looking to potentially contract out the building of this website so that you're able to offer Canadian-based equipment and for American purchasers to acquire it. And you're going to capitalize on the current exchange rate, which, as I've mentioned to you before, is currently in your favor. And you're going to be able to supply a large amount due to the fact that there are a lot of Canadian customers who are willing to sell because of the fact that there are a lot of Canadian businesses that are currently trying to liquidate their assets. So moving forward, the next issue is that, of course, this is going to require an aggressive marketing plan. As we're entering a new market, and with people who may or may not be familiar with our name, it's going to be crucial that we have a marketing plan that is able to demonstrate the fact that we'll be able to be a cost leader, but also demonstrate the fact that we're known for quality to these customers who potentially have never worked with us before. So what we're going to be looking at, so to our current customer base, we're going to be offering an incentive so we are not cannibalizing on the current US customers who drive up to our Ontario warehouse by offering them a discount. And in looking towards future customers, we're going to be using a combination of online advertising, direct mail to our existing customers and their businesses, and leverage the existing East Coast relationships and continue to partake in all the trade shows and the wonderful advertising you already do to ensure that we're able to grow in the East Coast on a state-by-state level. So the integration of appraisal, why we feel this would be really key. Currently, they're operating almost as separate businesses. They're complementary products. But in bundling them together, we feel that this will be able to differentiate you from many of the other products in the market. So if you look at somebody who's potentially looking to acquire something, you'll have people looking to buy a piece of equipment potentially off Kijiji, eBay, or other online manufacturers. But the problem with this is that there's no guarantee of quality, and this is where your company can really come in. We're suggesting that you can integrate your appraisals into every single transaction that you make online so that you're able to have that guaranteed and trust relationship that will be at the center of each transaction. And this will be something that currently none of the competitors have the experience, the credentials, or the capabilities to provide. So we feel that integrating this will really help in moving forward to safeguard you should other potential competitors look to enter this. So there's several things you need to look at down the road. Once you've successfully had your bank meeting, which we're confident you'll do so, you'll be looking at the following things. You'll want to learn the business, as we've mentioned before. You'll want to prepare for your growth. And at this stage, you'll have a pivotal point where you can decide should you choose to launch or not. And then growth around year 3 so that you'll hit a target of year 5 to 7.
Now, you're probably wondering at this point, what's this going to cost me and what am I going to get back from it? And then ultimately, how am I going to get there? And we're going to go into all of that in time. But just to look at quickly to begin with the cost. So there will be some costs associated with hiring some new employees, particularly someone to maintain the website after it's built, as well as the cost of actually developing the website and getting a launch marketing underway. So this will be a $210,000 cost over a 2-year period. And then there will be an additional at least approximately $200,000 a year in ongoing costs to maintain and actually grow the business. And where we're basically coming up with that is just at the end, we're thinking, as Ritchie Brothers has been so successful with, we're recommending that you continue to reinvest in the business just to develop the growth necessary to actually be able to exit the business in the time frame you're looking for. Now, what are you going to make from this? So what you're going to make from this is, as we mentioned at the beginning of the presentation, a 17% return on your investment. Now this is at a bare minimum because it really assumes a sales multiple of 6 times earnings at the end of 7 years, so that's what you'll be able to exit with. Now the way we came up with this multiple is that's basically the implied multiple that you've been used that is associated with the current $500,000 purchase price. And the reason that we think that we use this for our end valuation is just to be on the conservative side. So we wanted to say, okay, worst case scenario, you get the same multiple that you're able to get, and the improvements and the changes to the business are not reflected in a higher multiple at the end. Can you still make your money back? And the answer really is yes. So just in terms of $500,000 being a fair price, the fact that this is so far below the Ritchie Brothers multiples, which we looked at, so we looked at both trailing 12-month and also forward multiples, but in terms of this is well below. It's almost a third of the multiples we were seeing in terms of Ritchie Brothers, which is honestly to be expected given the fact that you're looking at buying a private company that is so much smaller and really just totally out of Ritchie Brothers leagues at this point. But it was still a useful thing to look at. In terms of the other valuation we used, it was the a DCF analysis, and really just the fact that you're able to get the 17% return just shows that this is a fair price, fair purchase price, and given our conservative exit estimates. Now, just touching back actually on structuring the transactions. So something important to touch on is you mentioned you were concerned, you were looking at mostly using debt. And we're recommending that you move forward with this, so it'll be a mixture of equity and debt. So you'll each be putting in the $65,000 equity investment, and then also securing approximately $455,000 in debt from the bank. And what this is going to be going to is it's financing the rest of the purchase price and also having the $150,000 you need to develop the web platform. And just as to why the bank would be willing to give you this money, to begin with, you'll be coming to them with this growth plan, showing them that you'll be able to pay them back. And at the end of the day, what it comes down to the bank is you also have security you can provide them. So the business has an associated $300,000 plot of land, so you'll be able to use that as a substantial portion of your security, and you'll also be able to use some of your own assets to backstop the rest of the bank loan. So getting this type of financing from the bank really shouldn't be a problem. Now, how long is it going to take to actually get to this stage where you'll be able to exit the business and make that return? So what we've really split it into is there's basically a 3-step implementation process. So the first step we're calling prepare. This will take about a year. The second is implement, and that's year 2. And then the third step is growth, and that'll be happening up until the time you choose to exit the business. Now, just for clarification, this chart you're seeing here is in half years, so that's a 4-year chart over half years. Moving on to the preparation stage. What it will first start off with is day one when you get into the business, just getting up to speed. So it's getting to know the types of, getting to know the employees, getting to know some of the key customers. We're recommending, just because it's unlikely you'll get to know all 1,000 key customers, getting to know, say, the top 20%. So that's that 80-20 rule of thumb, that the top 20% of your customers even are probably the ones that are actually the most important. Next is finding the right people. So what this really comes down to is, you mentioned that one of the skills you need to move forward with the online platform is some IT skills. So we'll be looking for someone who would have the capability to actually manage and handle the day-to-day upkeep of a large sort of sales website. So this is something there. And then also looking to search for the contractors. It doesn't really make sense to build the capability in-house to actually build the website, just because it would be such a large undertaking, but actually outsourcing that. So finding a contractor who can do the development of that website for you. Additional to this would be hiring an additional appraiser, just sort of getting that underway so that you'll be able to move forward and provide those guarantees for the increased volume of transactions that would be happening with the website. Next up, you'd be looking to launch the website first in the markets where you currently operate. So this would allow you to see what sort of traffic you're getting, what sort of people are buying online, if it's the same as your regular customer base, and basically allow you to tailor your marketing materials that you'd ultimately use in the US market for these sorts of things. Next, and it would also be a useful period of time for you to obtain customer feedback and ultimately improve the website so you can go forward for the final launch. Once the final launch happens, we're recommending that you move forward with launching that new sort of marketing campaign, continuing your person-to-person sales efforts as well, as it's a relationship business. So if you have large customers coming to the website frequently, looking to develop a better relationship with them. Ultimately, after you start with this recommendation in the northeastern United States, you'd be looking at branching out state by state to basically grow the people who are aware of your website. Next up, and then just ultimately after that is the time for exit.
So of course, as with any growth strategy, there's always going to be the potential for certain risks. We do think certain foreseeable risks could be potentially things such as duties and taxes. However, we're confident that your profit margin will actually supersede this. So should this happen, you actually have quite a bit of wiggle room to move around with. Secondly, that knowledge gap we've alluded to, you'll need to make sure you're able to cover those bases before your founders leave, and we think that you can do that and potentially keep them on as advisors afterwards by engaging them in a consulting agreement post-departure. And lastly, with any international business, there's always the possibility of logistical issues. However, we think that by expanding in the East Coast firstly and going state by state, one state at a time, you'll be able to mitigate these and adjust and pivot as you go along. So our issues for you today that we've outlined and our strategic recommendation really address all three conclusively. We're excited to finish off today by saying that we really think you'll be able to work in the 21st century and really bring auctioning out of the Stone Ages. And we're confident that in following this plan, you'll be able to get out successfully with a 17% ROI in 5 to 7 years. But in fact, we're so confident. Oh, sorry.
Judges, you can start your question.
How much, I guess two things, with respect, or a couple things with respect to the U.S., clearly a large market. How much did you consider what the competition would be there in terms of online auction platforms? And once you get onto online, there are potentially margin implications. Are you expecting to make the same margin on every transaction in an online business that you would in a physical business?
Absolutely. We did consider the competitive forces, but we believe that we have a competitive advantage in terms of cost leadership in the US. And that's because currently it's 69 cents US on the dollar. That means that even with duties and taxes, you are able to offer a lower price. And the second driver of that cost advantage is the fact that a lot of Canadian businesses are going out of business and liquidating, and therefore they are willing to sell as long as they can get the machinery off their hands. Now with that quality assurance piece, it's something that we can provide them with on top of that cost leadership. So we are confident that we do have competitive advantage there.
Is there another slide after this? I see something here.
The extra slide, it was just a summary of some of the calculations we did.
So, how much loan are you planning to take in total? there's 305,000 and is
Yep.
there additional loan?
So the total loan would be 455,000 to actually go through with the transaction, the building, and the website.
Do you have any projection of sales or revenues you could take to the loan officer and show that the rate of return that we get or we receive on this is higher than 5 to 7% loan interest rate?
Yep, for sure.
Higher, I mean, to me, it has to be over
Yeah.
20%, but let's say.
Yeah, so basically what we had in here is all of our sales projections were just internal to that calculation we did for the 17% return on investment. We didn't include the whole full spreadsheet in the presentation just because it's too many numbers to put up here for a presentation, but we'd be happy to provide you with it before you actually go meet with the loan officer at the bank.
A little further in explaining how you can secure $450,000 to loan. You talked about assets. Which assets?
So there's assets in terms of a house and a car with equity in them, and really the quantity of this, in addition to the $300,000 in land held by the business, we feel is more than covers the $455,000 that are being requested.
So are those one-time costs of $210,000 that you're looking to cover that all within that $455,000 loan? So purchase the business and those one-time costs?
So because you'll be reinvesting back into the business as opposed to paying out all of your cash flow and dividends, the previous owners were paying out in the neighborhood of $100,000 to $150,000 in dividends per year. Just by reinvesting that in the business, as those costs are split over 2 years, you'll be able to cover them with your ongoing cash flows.
You talked about having every piece of equipment come with a certified appraisal. How do you implement this logistically, and what costs are involved? How much is that going to increase your cost and decrease your margin in the online space?
So the way we're looking to implement it is going to be a slight rearranging of the current people that you have within your business. So as you've mentioned to us, currently you only have a fixed amount of appraisers that are able to do this type of work. But we're confident that as this plan goes along and more people require appraisals, that you'll be able to invest more and potentially either recertify some of your other members that don't currently have the certifications needed to appraise, or to hire on additional people. As far as cost goes, the beauty of an online system is that you can really monitor and implement things as you go along, and as we've mentioned in our plan, it's going to be on a state-by-state level, so we can control costs, and if we're finding that we're not using our resources efficiently, we can potentially monitor them and implement them as we go.
Through the online, you're going to target northeastern U.S., but online sales, how do you restrict it from going to the West Coast or the south of the U.S. and incur those additional costs? How do you restrict an online platform to a certain region?
So that's definitely a concern that we have taken into account. You're inevitably going to not be able to completely restrict it. We're going to be focusing our marketing efforts, however, primarily on these regions. And in fact, right now, we only have customers, or the vast majority of our American customers are in the US, on the East Coast, because they've been used to driving up to Ontario and conducting business with us there. So it's not going to be possible, of course, to restrict it entirely, but we're hoping that by the time that word catches on in other states, since we're not doing direct marketing there, that by this point we'll be able to have ramped up our operations to potentially handle this at that point.
That's my time.